Hey folks, Dan Frio here with your closing bell for March 14th, 2025. So the reason why I'm doing this a little early, it's 70 degrees here in Chicago and I want to spend some time outside. So without further ado, let's get over to it. So what I'm going to try to explain to you guys today, once again, is rates ticked up once again. And guys, I know my banners are saying rates are crashing. You might not realize rates last year were 8%. So now we have rates at 6.8. So that's 120 basis points lower. That's a crash. Every day they're teetering a little bit, but what I'm trying to explain is why this is happening. So let's get to it. Right through here, here's what happened in the equity markets. They had a fantastic day. That's why I kept saying, guys, hold off. Well, I'm not going to say it's not going to crash again on Monday, but just don't panic, folks. Everything's going to settle down. Trust me on this one. We're going to talk about in this episode is, well, why did this bounce back? But what we really want to focus in on is mortgage delinquencies. Are we going to get inundated with delinquencies and foreclosures, bringing home prices down, crashing like they were years ago? Well, that's what we're going to talk about here in a second. And has house prices finally tapped out? We're starting to see real estate asset values falling. So that's what we're going to talk about in this episode. So without further ado, let's get to it. So my name is Dan Frio. I actually do this report twice a day. And my whole goal here is to help you understand this stuff. How the markets, how the world, how the bond markets and oil and everything else affects real estate. And the biggest thing we talk about here is interest rate and mortgages. The reason why is I'm actually a loan officer. That's what I do for a living. I don't do YouTube videos. Our unique slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, how do we do that? Well, the interesting thing is, too, I can now help anybody in the entire country, even if you live in Puerto Rico. So how do we do that? You have to stay to the end of this video to find out. So let's get over to the markets that we're seeing right now. Right now, there is a comeback coming. Well, it says comeback rally coming. Is this going to last? Well, we got some good news from Russia and Ukraine. It looks like there might be some settlements there. The Middle East looks like it might be settling a little bit as well. And the good news here is even the stock market's starting to settle a little bit. Look right over my head, the VIX. It says VIX. That's the anxiety level on Wall Street. That number is usually about 12. It's at 22. That means the markets are skittish right now. So any reaction to anything is going to cause a huge ripple effect through the markets. It's not normal that we see 500, 600, 700 point moves or swings in the market. Look at the Dow Jones today. It's changed 500 points, 600 points today, 600 points yesterday. It's crazy out there. So let's get over to what's behind all the scenes on some of this. So I want to talk right now, though, about mortgage delinquency. Okay, so a lot of people were predicting, okay, going to go into a recession. Everybody's going to lose their jobs. The housing market's going to crash and the world, it's just going to be a terrible thing. So I want to go through delinquencies and then I want to also talk about home values here for a second. Now, I try not to talk about value. I don't know what your market's doing. This just gives us the national trends. You might be in a market that's doing fantastic. You might be in a market that's doing terrible. I don't know what your market's doing. So I have to work on the broad markets. So let's get over to this. This is saying basically what mortgage delinquency is doing. So the young man in this article, he writes in this entire housing cycle, I've argued that we would not see a surge in foreclosures that would be significant impact on home prices, as happened in the housing bubble, for two reasons. Mortgage lending has been solid, which it is crazy solid, and most homeowners have substantial equity positions. Okay, so let's look at those equity positions. Right now, the headline for this one says real estate asset values falling. Okay, so let's look at this chart. This gives us how much home prices have done over since 2000. And then this is the loans on those homes. Okay, so I want you to see two things. One, this is that housing crash of 2008 you always heard about. And it lasted, basically, it ended in 2012. So it lasted a while and it dropped substantially. I won't say it didn't. But here's the interesting piece of this is people since 2020 or 2021 has been calling a crash. Well, if you go to look at that, right here is where we were in 2020. This is going to say 30. Where are we now? About 48. So I don't think there's a crash in there anywhere. Okay. A lot of people predicted that in June of 2022, that was the top. Like, I don't see a top there because the demand is still there. Well, it went down a little bit and then we went right back up. So what you also have to understand is look at this line from 2012, basically 2024, 12 years, it was nothing but up and away. So here's the equity position. If you've been in a home for any length of time, this is the equity positions that you're building. So most people shouldn't get foreclosed on because of the equity position. You get foreclosed on when you owe more on your house than it's worth. What happened back in these days? Look, home values just start plummeting because of subprime mortgages. People put their houses on the market in loads. They were selling them, giving away, giving the keys back to the banks. They were just walking away from these things. Values plummeted. Then the equity position squeezed, and a lot of people were squeezed out. Look at the equity position today. I'm not saying this for all borrowers, but if you've been in your house for 2-3 years, we always say, stay in the house for 5 years, then you'll be okay. If you heeded that word from us and you bought in 2019, look where you are today. Okay, so not bad advice there. So please be cautious of some of the things that you look at and see and watch. I just want to give you nothing but the facts channel. So now let's get over to the bond market. Now, what in the heck's happening to the bond market? Well, this is the crazy part. Okay, what's going to happen between this, what you have to do is follow this and the stock market, because people are moving their monies back and forth. Investors, like big investors, not $100. We're talking millions, billions, and a lot of money moving transactions. Okay, so when there's uncertainty in the world, like we have Russia, Ukraine, the Middle East, and then in our country, we have the unrest, the immigration, the political tensions that we have, all these things that divide the country. Usually what happens is people just completely pull their money out of equities in the stock market because it's way too risky for uncertainties. But in today's world and market, the stock markets are basically a world market. So what people are doing is they're moving their monies into different positions. Okay, and there's a lot of other dynamics behind this, like our national debt and things like that, which you're going to see over time. There's going to be big volatility in the market. You just saw it. It's now down 14 ticks. That's why we locked everybody the other day, because mortgage rates are probably up another, maybe 7-10 basis points. We're trying to time this market. And that's why I keep telling everybody, pigs get fat, hogs get slaughtered. And what I mean by that is if you have a mortgage right now, rates, 8% or 7.5%, 8%, 8.25% plus. You need to get out of that. Don't wait for the rates to go back to 5 because see it anytime soon. Sorry to get off on a tangent. But you're seeing the market move right now. So money's moving back and forth. There's tariff issues. There's just uncertainty everywhere. So you're going to have volatility everywhere. And this is one piece of that market. So we've been trying to help our clients time this market in a timely manner. And we pretty much nailed it this week with a lot of the inflation numbers and everything else that came in. So that's that part of the equation. So now let's get over to one piece of the puzzle. Let's go and recap this whole thing. Mortgage rates ticked up a little bit. We locked in almost everybody we have because I don't like going into weekends with people unlocked. I just don't know what's going to happen. And I don't want to go back, to you by Monday and say, sorry, but we didn't lock you in. Now your rate's up 0.25%. Probably wouldn't be happy with. So mortgage rates are basically, I'll say they're stable today. The equity markets are loving what's going on basically throughout the world and with the economy right now. There's foreclosures aren't going to hit the markets in masses, folks, if that's what you're waiting for. Home values, have they peaked out? We don't know. If you're you might be in an area that's doing well, or you might be in an area that's doing not as well. Don't look at the national averages, folks. Just look at what your area is doing. I try to plead that to people. The bond market is, let's just say it's stopped basically at minus 14, means mortgage rates might tick up just a little bit today. But that's it. That's the report for today. But before you go, I need one last thing from you. You're looking to buy a house. Like if you need my help buying that first house or maybe that first investment property, or maybe even looking to refinance, I need you to do one thing before you do anything. This is very important. We need to stop trigger leads. Okay, what are trigger leads? Trigger leads are when somebody pulls your credit, if you're looking for a mortgage or a car, the credit agencies are selling your data, folks. Okay, I don't know if you know that. So once your credit gets pulled, you're going to be inundated with phone calls. I have a young man that he's tracking me daily. He's up to, I don't know if he said 90 recently, but I think he said 90. So if you want to stop that from happening, just go to optoutprescreener.com. It's just it's a system the government has or the credit agencies has. Stop that data from being sold. Please do that. You'll thank me. Who I am and what do I do? So my name is Dan Frio. Our slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. Now, how do we do that? Well, it's pretty simple. I work at a federal bank that is fantastic. We have a federal license. We can lend all over the country as well as Puerto Rico. The cool thing about this bank is their ingenuity is amazing. They're actually setting us up with, right now we have over about 33 different lenders we can work with. So here's how it works. You apply with me at my bank. We use our products, our rates, and everything else. But I also have 33 other banks on my side that I can use their rates, their programs. Some of them have down payment assistance programs that are fantastic, $6,000. Some are $4,500. You're an investor. You need a DSCR loan, DSCR loans. You need a reverse mortgage. Do reverse mortgages. We specialize in refinances and helping people buy their first homes. So if we can help you, I'd love to help you. My name is Dan Frio. And if you want to work with me, just go to the rateupdate.com. You can put in your application right through there. What I'll do is before I pull credit or do anything, I'll call you. I want to know your story, answer any questions that you have. Love to help. Okay. And that's what we'll do. If you want to schedule a one-on-one consultation with me, you can do so right through. If you want to just call in, you can do so down through here. Just go to the bottom of my website and you'll see right down through there. Our 800 number is 844-775-5626, or you can reach me personally at dan@rateupdate.com. Thanks so much for watching, folks. God bless. Have a fantastic weekend. Enjoy this weather. I'm in Chicago and it's 70 degrees here. I'm heading out the door. Maybe just walk around the block. Take care, folks. God bless. Have a fantastic weekend. Hope to see you back here next Monday.